Jeff Bezos just lost his spot as the world's fourth richest man, and it's all because of a $200 billion receipt. That is not a typo. $200 billion in a single fiscal cycle. While the rest of the world is debating interest rates and consumer spending, Amazon just dropped a financial nuclear bomb on the market, and the shockwaves are currently wiping billions off their market cap. For years, Amazon was the safe bet, the king of retail and the titan of the cloud. But something changed this morning. The everything store just became the everything at stake store. The market isn't just nervous, it's terrified. Wall Street is looking at that price tag and asking one simple, brutal question. Has Amazon finally bitten off more than it can chew, or are we witnessing the most aggressive land grab in the history of capitalism? The chaos started with the Q1 2026 earnings report. On paper, the numbers looked decent, but then came the Capex disclosure. Amazon revealed a staggering $200 billion capital expenditure plan specifically earmarked for AI infrastructure and next-gen robotics. The reaction was instantaneous and violent. The stock plummeted 9.3% in a single day, erasing nearly $200 billion in shareholder value in a matter of hours. This is the biggest single-day drop since the post-pandemic correction, and the reason is clear. Investors hate uncertainty. They see $200 billion leaving the coffers, and they don't see an immediate ROI. They see a company that used to print money suddenly pouring it into a furnace of R&D and silicon. Andy Jassy is essentially betting the entire farm on a future where Amazon doesn't just deliver your packages, but owns the very intelligence that runs your life. This isn't a pivot, it's a total reinvention of the company's DNA, and the market is punishing them for the audacity of it. So why is Andy Jassy doing this? Why risk the stability of a trillion-dollar empire? Because this is a total war. Amazon is currently locked in a three-way deathmatch with Alphabet and Meta for the soul of the next digital era. They realize that being the cloud isn't enough anymore. You have to be the brain. The centerpiece of this $200 billion gamble is something called Project Suncatcher. Following in the footsteps of the SpaceX AI merger, Amazon is moving toward its own space-based data centers. They're leveraging Project Kuiper, their satellite internet initiative, not just to provide Wi-Fi, but to house massive orbital AI compute clusters. By putting the brains in orbit, they bypass the terrestrial energy crisis that is currently strangling Google and Microsoft. But it's not just about space. A huge chunk of that cash is going into the mass production of their own custom AI chips, Trainium and Inferentia. They want to decouple from NVIDIA entirely. If Amazon can own the chips, the servers, the satellites, and the delivery robots, they become an unbreakable monopoly that exists outside the traditional economy. The personal stakes here are just as wild as the financial ones. For the first time in years, Mark Zuckerberg has officially overtaken Jeff Bezos in net worth. While Bezos sees his fortune dip alongside Amazon stock, Meta's lean, AI-focused Meta is soaring. It's a bitter pill for the Seattle giant to swallow. The narrative on the street is shifting. Is Amazon over-leveraged? Are they spending today's profits on a tomorrow that might never come? Or are we looking at the buy-the-dip moment of the decade? History has shown us that every time the market hated Amazon for spending too much, whether it was on Prime, AWS, or logistics, the market ended up being wrong. But $200 billion is a different league. This is a gamble that could either cement Amazon as the undisputed sovereign of the 21st century or become the first crack in an empire that finally grew too large to support its own weight.